the fluctuation in terms of price will keep on happening, and this is going to be a serious challenge altogether. Growth will not happen just because you have certain demanding factors in your economy. RBI will decide at what rate I can provide a loan, at what rate the interest should be given to the bank. Factor that is the matter that on which the entire economy is running today. The average daily balance that a bank is required to maintain with the Reserve Bank altogether. Good morning and welcome to the second session of Unit 2, and this is going to talk about the monetary policy in our country. Now, the word monetary itself, most of us know that it is going to deal with money and the credit factors, but then monetary policy has got a lot of other things also in governance. So let's have a quick look into the monetary policy of India. Now, the primary objective of monetary policy is to maintain price stability while keeping in mind the objectivity of growth. Let me just take a small time out here. I'm talking about two key factors. One side, I'm talking about stability. The other side, I'm talking about something called as growth. So how is it possible that when you are stable, how can you achieve growth? Now, the question here in economics is that stability versus growth has always been a million-dollar question for most of the economists in terms of building up their nation. Many times it so happens that in order to bring in a barricade to the rising inflation, we try to correct the market, we try to make the market more stable. On the other side, when we feel that markets are not growing up to the mark, markets need a push, they need an inflation, they need to grow up, what we tend to do is that we raise the prices in order to see the growth and consumption going up. So for the monetary policy, which is governed by the RBI, the major role comes in terms of managing a balance, managing a stability altogether. Where is that they are able to get that stability? Where is that they are able to strike a balance, go back and tell to the world that this is how we have been able to run the country in the given situation? So that is why I would say that monetary policy is probably one of the most important, crucial factor that we can ever talk about. Now, the price stability is a necessary precondition to sustainable growth. If you're talking about the current situation in India, the post-COVID scenario altogether, people ask this question, why is the prices gone up all of a sudden? Is it because of a recovery path? Is it because of inflation? Or is it because of the factor that the manufacturing has just come down? Now, the answer to this question comes with the factor that if you want to push an economy from a recession level to that of a growth level, that means there is going to be a serious precursor that has to come into the factor. So we need to start bringing in the price stability factor. This fluctuation is going to happen in the country for some time. Price stability can be brought into picture only when the production of the goods, production of necessary goods have been brought back to the normal condition altogether. Until then, the fluctuation in terms of price will keep on happening, and this is going to be a serious challenge altogether. So are we ready to go back and say that yes, we are okay with the inflation in spite of the fact that India is facing a recession at the current level? Are we ready with the factor saying that with all this, let the price go up, let the price keep moving forward in order to increase the demand factor? Now, this is where the RBI comes and says that price stability can be maintained if you are able to get a good monetary policy in place. So in the year 2016, RBI Act 1934, which was amended in order to provide a statutory basis for the implementation of a flexible inflation targeting framework. Now, that's quite a big name altogether for us to understand, but just going by the factor, what did RBI exactly tend to do here is that they amended the policy saying that at any given point of time, based on the requirement, based on the need factor, let us go forward and try to bring in an inflation condition. Let us try to bring in a monetary policy that can target the inflation and take it as the requirement altogether. So RBI has tried to amend the situation as per the need, as per the regulation, and RBI believes that it is not mandatory that we follow a stable monetary policy every time, we follow the same act every time. As per the requirement of the situation, when the economy has to be pushed back, when the economy has to recover back, there is a need that is coming into picture. Now, moving forward, the monetary policy framework. The amended RBI Act provides a legislative mandatory for the RBI to operate the monetary policy framework of the country. So definitely RBI gets its authorization. It becomes a legal framework here for the RBI that yes, I am going to facilitate the monetary policy of this country. Now, what does this framework consist of? It aims at setting a policy, the repo rate, what we call it as the repurchasing rate altogether. The repo rate is going to be here where we are going to talk about an assessment of current and the evolving macroeconomic situation, modularity in terms of the liquidity to anchor the money market rates at a particular rate. The repo rate will definitely talk about the money market that's going through the entire financial system and influences the aggregate demand, inflation and growth. Whole lot of economics here for us to understand, but then that is the factor, that is the matter that on which the entire economy is running today. When I talk about the monetary policy, somewhere down the lane, RBI takes a gatheration, RBI takes a stand and tells it very, very clear that I will be doing this act, I will be taking this policy seriously into picture when I decide in terms of building up this situation. So what does the RBI exactly do is that RBI will try to understand the current macroeconomic situation. Where is the demand? Where is the supply coming into picture? The employment rate or the growth rate factor, the agriculture, the interest rate, the living conditions in primer. Based on these factors, RBI will be able to understand what is the kind of monetary policy that has to be suggested so that they are able to control the financial system with an appropriate face altogether. And this is highly important here. Why? Because RBI is not going to take any matter so lightly, and they are not just going to bring in a policy which is going to just say to the people that yes, growth can be stimulated. Because tomorrow people are going to come back and ask, how is the growth going to get stimulated in spite of several macroeconomic conditions which are still persisting? Now, that is why the repo rate, which is a very, very important factor that has been talked about, once it is announced, the operating framework is designed by the RBI, which tries to envisage the liquidity management, the day-to-day basis, and what they try to do here is that they also go upon a factor called as the WACR, the weighted average call rate, and around the repo rate, which tries to anchor, which tries to put a fixture to the money market. It says that this is the rate at which we can trade. This is the rate at which the money market needs to function in the economy. So what we are trying to do here is that we are trying to fine-tune the economy altogether, revise the rate depending upon the evolving financial markets. Now, if I have to give you a live example here, during the situation of the pandemic, there was a time when the gold kept on moving up and it suddenly became to that height where it almost touched about 5,500 rupees per gram. Now, of course, the gold has again started coming down, but then let's look at the volatility that was happening in the market, which made this yellow metal to surge literally to great peaks, to great heights altogether. The reason for this was that suddenly a depression in the economy, the money coming down, the flow is completely being stagnated, there is no investments, there is no direction at all, and people suddenly going in for a backup for the survival. There's a push coming in altogether. Now what happens here is that moment RBI comes forward, announces the repo rate, the interest rate factors of lending and borrowing all together, there is again a push coming back into the market as in how much we can buy, how much we can sell, and at what rate we can do the business, which is going to determine the functions of the economy. So at any given point of time, RBI is going to stand as a tall member who's going to govern the framework policy. Without the monetary policy happening in terms, the action would completely become void. So that is why I would always say here that RBI's intention is to bring more stability into the economy rather than just progressing on the growth factor. Growth will happen once the price stability is achieved. Growth will not happen just because you have certain demanding factors in your economy. What does the monetary policy actually try to focus here is that try to bring in a system on which the financial aspects of the country are in well-placed, are in well-tuned condition. So when you are able to tune the entire system, you are able to bring in a force into the system, automatically you will be able to see growth, automatically you will be able to see a greater development altogether. Now, moving forward, we're also going to talk about the process that is involved in this policy matter. Now, the MPC, the Monetary Policy Committee, determines the policy interest rate that is required for the inflation target. The first meeting of MPC was held on October 3rd and October 4th, 2016. The markets in India took a heavy volatility on that date. Why? Because of the MPC committee meeting. And from that time, it has been running as the fourth bi-monthly policy statement of 2016 and 17. It has been a regular factor altogether. Almost you can see that every 4 months, every 3 months, you will be able to see that a monetary policy committee would be meeting up in the RBI premises, and RBI would be releasing it to the press about what is the stand they have taken in the current situation. So the Reserve Bank's Monetary Policy Department, what we call it as the MPD altogether, assists the Monetary Policy Committee in terms of formulating the monetary policy. The views of the key stakeholders in the economy and the analytical work of the Reserve Bank contribute to the process of arriving at a decision on policy repo rate. Definitely a very, very important and a crucial factor that I would like to talk about. Why? Because the Financial Markets Operation Department, called as the FMOD operations, what they try to do here is that they try to work on the monetary policy mainly through the day-to-day functional activity, the liquidity management operation, and the Financial Markets Committee, that is the FMC, meets the daily need, the daily necessity, the liquidity condition, so as to ensure that operating target of the weighted average call is being met. So we typically try to understand this as the key factor. The Monetary Policy Committee consists of very eminent people who join hands together, who know the economy, who understand the various factors, the nuances of the economy. They try to join hands together, try to understand how to bring forward a stability in the picture. Now, before the constitution of MPC, the Technical Advisory Committee, called as the TAC, on monetary policy experts from the economic, central banking and from different walks of life have been taken together in order to understand the stance of the monetary policy. However, its role is only an advisory in nature. They have never been in terms of a direct implementation that you can ever talk about. So that role of TAC, the Technical Advisory Committee, is more only in terms of just providing solutions and suggestions, a consulting role. But with the formation of MPC, the TAC on monetary policy ceased to exist. So the TAC is now completely gone out of the Monetary Policy Committee. committee, and it is the MPC itself which decides the action on a regular basis. So with this force coming into picture, you will be able to understand and you will be able to go forward understanding the core concepts of the monetary policy, how the process works, how they bring back a stability into the system. Now, moving forward, what are the instruments of the monetary policy? Starting with the repo rate, the fixed interest rate at which RBI provides overnight liquidity to the banks against the securities, against the collateral of the government and other approved factors. So we call it as the liquidity adjustment facility, or the LAF altogether. So what is a repo rate? Let me again try to repeat and tell it to you. RBI providing loans or lending the money, overnight liquidity to the banks at a fixed rate of interest is called as repo rate altogether. Now that is very, very important. Why? Because RBI will decide at what rate I can provide a loan, at what rate the interest should be given to the bank. Now, if RBI is charging a higher rate altogether, then that will also have an effect on the banking system. If RBI is going to reduce its stand in terms of lending the money, then the banks will be easily able to get their liquidity requirement. So now for RBI, this becomes a very, very important stance in determining how much money should be given at what rate of interest to the commercial banks, followed by the reverse repo rate. The word itself is quite easily understandable. Reverse repo rate, the reverse of repurchasing altogether, which means a fixed interest rate at which RBI will absorb liquidity on an overnight basis from the banks against the collateral eligible under that liquidity adjustment facility altogether. So even RBI will take money from the banks on a regular process and will come back and say that yes, we are being able to take this money at a particular rate of interest. So they will also try and go forward in terms of adjusting the liquidity facility factors. Now, the other factor is the LAF itself. Let's talk about this LAF, how important it is. It consists of an overnight term as well as the repo auction. So progressive layers of the RBI has increased in proportion of liquidity. They have to understand how much money is being injected in terms of the business, in terms of the tenor. The main aim of the repo is to develop the interbank money rate exchange. Plus, they also understand at what rate the market is set and how these loans can improve the transmission of the monetary policy. So it becomes very, very important. The Reserve Bank will also conduct variable interest or reverse repo rate that comes into picture as necessitated under the market conditions. So this is very, very important for all of us to understand and to know. Why? Because at any given point of time, when the actions are being done, when the necessitated facilities are being done altogether, they have to be in the factors of adjusting the liquidity in the market. So, for example, in what rate the loans have been given, in what rate the assets have been valued, and what is the pricing, what is the interest rate, all can be determined using the liquidity adjustment facility, or what we call it as the LAF. Now, the instruments also include the marginal standing facility. This is a very, very simple factor where we try to understand a scheduled commercial bank can borrow additional amount overnight. Now, banks can do it by dipping into their SLR, that is the statutory liquidity ratio. That is also an important factor. Followed by the corridor. Corridor means here is the rate, the MSF rate, that is the monetary statutory factors, the reverse repo rate, the daily movement in terms of the bank rate, that also comes in as a corridor. The cash reserve ratio, which is a very, very important factor. The average daily balance that a bank is required to maintain with the Reserve Bank altogether. Now, this is a mandatory factor which they have to do. Followed by the bank rate. It's a rate at which the Reserve Bank is ready to buy or rediscount bills from the commercial banks from the other papers altogether. So you can see that there's a whole lot of factors that are involved in the monetary policy, and each and every factor will try to undermine, will try to determine the entire concept of monetary policy. Why? Because each and every rate is very, very important for all of us. Now, The other thing is the SLR factor. The SLR is the statutory liquidity ratio, that is the share of NDTL that they need to maintain in terms of the safe and liquid assets. And this is going to be in such a way that encumbered by the government securities, cash and gold. The changes in SLR will influence the availability of resources in banking for the system, for the lending of the private sector. Now, the open market operation, this includes the purchase and sale of government securities which have been done for the injection in terms of liquidity. So many a times what happens is that government requires money in terms of assets, in terms of purchases and all those factors. So it becomes very, very important that when you need to inject money into the system, when you need liquidity to come into the system, automatically there is a factor called as the open market operation where the government can both buy and sell the bonds and the commercial papers in order to bring in more liquidity, followed by the market stabilization scheme. This is a very, very important concept, and this was introduced in the year 2004. Why? Because the surplus money that has been generated or that is there in the market by the capital inflows can be adjusted to the government securities and bills, and this can be also mobilized with an account held with the RBI, so that whenever you need those excess money, whenever you need that factor to be injected back into the economy, we can use this and stabilize the market back. With this, I come to the conclusion of this session. I hope and believe all the information shared in this session is of a great help and of a great resource to you. In the upcoming sessions, we will be talking more about the banking functions and how the roles of bank is becoming an indispensable factor in terms of building up our nation's economy. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me on this wonderful session today.